What if the 2025 crash is coming not because of a single catastrophic event, but because of the mathematical certainty of a system pushed too far? Let me separate the signal from the noise, because there's a difference between a crisis that's coming and a prediction that's wrong, and the only way to know which one this is to follow the data, not the hype. In 1929, stock valuations reached extremes never seen before. The price-to-earnings ratio hit 33. Everyone said new technology had changed the rules. Electricity, radio, automobiles, they believed the old valuation metrics were dead. But the metrics weren't dead. They were warnings. Within months, the market collapsed 89%, and everyone who believed the rules didn't apply lost everything. In 2000, the Nasdaq peaked at 50-50. Technology stocks traded at absurd multiples, 100, 200, 300 times earnings. Companies with no revenue had billion-dollar valuations. Everyone said the internet changed everything, that value didn't matter anymore. But it did matter. The bubble burst. The Nasdaq fell 78%, and a generation of investors learned that gravity applies to markets too. And now, in 2025, we're hearing the same story again. Artificial intelligence will change everything. AI companies deserve extreme valuations. The old rules don't apply. But here's where things get interesting. The old rules do apply, but the situation is different from what most people think. The compression of the Magnificent Seven into 30% of the index is real. The stock valuations at 28 times earnings, double the historical average, is real. But what's also real is that corporate earnings have grown, that productivity has increased, that the Mag 7 dominance is receding as market breadth improves. September 2025 saw 59% of S&P returns coming from non-Mag 7 stocks. That's the first meaningful diversification we've seen. This is confusing because both things can be true. Stocks are overvalued in absolute terms and yet more justified than during the dot-com era. This is why simple crash predictions fail. The world is messier than the models. But here's the part that matters. Whether stocks are overvalued by 10% or 40%, something is clearly wrong. And when something is clearly wrong, it has to correct. The magnitude and timing of that correction, that's where prediction fails. Let me show you what's definitely happening, what might be happening, and what's almost certainly not happening. The residential real estate market is undeniably overvalued. Home prices sit at approximately 5 times median income in many major metros. Los Angeles reaches 12.5 times income, San Jose hits 10.5 times. These aren't normal valuations. By any historical metric, housing is 40–50% above trend. This is worse than 2008. That part checks out. And when a market reaches this level of overvaluation, it doesn't stabilize indefinitely. It corrects. The only question is how much and how fast. A 20–30% correction in housing is totally plausible. A 40–60% crash in most markets is theoretically possible, but requires a catastrophic trigger. Commercial real estate is genuinely problematic. Office vacancy is real, though not quite as extreme as some claim, 19.6% nationally rather than 45%. But $950 billion in commercial real estate debt maturing at 7–9% interest rates when it was originally financed at 3% is a real problem. The math breaks. A property that barely cash flowed at 3% is bankrupt at 8%. Defaults are coming. Bank losses are coming. Some regional banks will likely fail. That part is fairly certain. Where things get speculative is the cascade theory. Will commercial real estate defaults trigger a systemic financial crisis? Or will they trigger a regional crisis that stays contained? History says it depends on interconnection. If the losses hit regional banks that are isolated, they fail and others absorb the good assets. That's 2008-style resolution. But if the losses hit the mega banks, if the interconnection is deep, then you get cascade. We don't have perfect visibility into that interconnection. No one does. The government debt situation is real, but the narrative oversimplifies it. $38 trillion of debt at 125% of GDP is genuinely unsustainable. Interest payments at $1.2 trillion annually are genuinely concerning, already the second largest budget item. The trajectory is bad, but the narrative that this creates imminent collapse is incomplete. Here's why. Governments with fiat currencies can restructure debt in ways that companies cannot. The US dollar is the global reserve currency. There's persistent demand for US Treasury securities. The government hasn't lost access to credit markets. This doesn't mean there's no problem. It means the problem unfolds differently than a corporate bankruptcy. The most likely scenario is fiscal pressure forcing eventual policy choices. Cut spending, raise taxes, allow inflation, or some combination. None of these are easy. All create economic disruption. But disruption is not collapse. Now here's what's genuinely confusing the analysis. Every warning signal people are watching has a legitimate basis. Warren Buffett sitting on $325 billion in cash, that's real. Insider selling spiking, that's happening. The Buffett indicator at 230% of GDP, that's accurate. The yield curve normalizing after 27 months of inversion, that's factual. These are legitimate signals that valuations are stretched, and prudent money is taking chips off the table. But legitimate signals don't create crashes. They create corrections, and maybe recessions. And here's the critical part that most crash narratives miss. The yield curve indicator that's supposed to predict recessions has actually already fired. It normalized in September 2024. Historically, recessions come 12 months after normalization, so we're already in or approaching the window. If a recession doesn't materialize in the next few months, if we get through 2025 without dramatic economic deterioration, then the yield curve signal either failed or it's delayed. That's not speculation. That's just time passing and data updating. The SARM rule, the other supposedly infallible recession indicator, hasn't triggered. Unemployment needs to rise 0.5 percentage points from the 12-month low to signal recession. We haven't hit that yet. Are we closer? Yes. Is it imminent? Not according to the data. The institutional response to this moment is actually important to understand. Risk management systems at major funds are not in panic mode. If we were genuinely headed for a 60–80% market crash, you'd see more dramatic repositioning. Instead, you're seeing gradual reduction of risk, steady conversion to cash by sophisticated players, but not panic dumping. That's the behavior of someone who thinks a correction is coming, not someone who thinks the system is collapsing. Now here's where it gets serious. There are legitimate second-order risks that don't get enough attention. Commercial real estate defaults will create real bank losses. Those losses will reduce bank lending capacity. Reduced lending capacity will slow business expansion and hiring. Slower hiring combined with high consumer debt will create delinquency pressure. Delinquency rises will reduce consumption. Reduced consumption triggers recession. That chain is plausible. It doesn't require a crash. It requires moderate economic stress spreading through interconnected systems. That's not unprecedented. That happens roughly every 7–10 years. We haven't had a recession since 2020. By historical averages, we're due. But due doesn't mean imminent. Due doesn't mean dramatic. It means when the cycle turns, it might turn ugly. Let me walk you through the most likely scenarios based on available data. Scenario 1. The base case, 65–70% probability. We get a moderate recession in 2025–2026. Stock market corrects 15–25%. Commercial real estate shakes out into defaults but stays relatively contained. Regional banks struggle, maybe 2 or 3 fail. Federal Reserve cuts rates to 2.53% range. Economic recovery happens over 2–3 years, not 5 years, not 10 years. This is neither apocalypse nor smooth sailing. It's just normal economic cycling at an elevated level of disruption. Scenario 2. The bear case, 25% probability. A deeper recession occurs with stock market falling 30–40%. Commercial real estate crisis cascades into banking stress more broadly. Unemployment rises to 7–8%. Debt becomes a genuine policy crisis. Federal Reserve faces difficult choices between inflation and deflation. This is painful. It's not fun. But it's also not unprecedented. We had something similar in 1982. We had something worse in 2008. The economy survives and eventually recovers. Scenario 3. The catastrophic case, 5% probability. This is the scenario the crash narratives describe. simultaneous collapse in stocks, bonds, and real estate, a 65–80% market crash in months, not years, multiple bank failures triggering FDIC exhaustion, housing market freezing entirely, unemployment exceeding 15%, federal policy tools proving insufficient. This is the depression scenario. It's theoretically possible, but it requires multiple cascading failures to occur simultaneously and for policy responses to fail completely. The probability isn't zero, but it's quite low based on current data. Here's what separates analysis from hype. Analysis says the system is stressed and a correction is coming. Hype says the system is rigged and a collapse is inevitable. The data supports the first claim more than the second. The economy isn't in freefall. Labor markets haven't collapsed. Credit spreads haven't blown out. Corporate earnings haven't crashed. These would all be warning signs if they were happening. They're not. What is happening is exactly what should happen at the top of a cycle. Valuations are stretched. Prudent money is getting defensive. Growth is slowing. Delinquencies are rising modestly. And the Fed is trying to navigate between competing risks without crushing the economy. This is the normal pattern of late cycle, not collapse pattern. Now, does this mean there's no risk? No. Does it mean the next 12–24 months will be smooth? No. Does it mean you should ignore all warning signals? Absolutely not. What it means is that the most likely outcome is disruption, not catastrophe. Recession, not depression. Significant losses for careless investors, not destruction of wealth across the board. If you're heavily concentrated in Mag 7 stocks, if you have no cash reserves, if you have no diversification, if you're leveraged, then yes, a correction hurts you significantly. Correction becomes crash in your personal portfolio. But if you have any prudent positioning, if you're diversified, if you have some dry powder, then a correction is an opportunity, not a catastrophe. This is where narrative economics fails. The crash narratives need catastrophe to be true, because that's the compelling story. But compelling stories aren't necessarily true. The real story is messier. The stock market is overvalued but supported by earnings. Commercial real estate is problematic but contained. Government debt is unsustainable but not immediately catastrophic. Consumer debt is stressed but not at breaking point. These are all tension points. Any of them could trigger cascading problems. But tension isn't collapse. The question you have to ask is not are we in danger, but is the danger immediate or delayed? The data suggests delayed. The Fed still has room to cut rates. The government still has access to credit markets. The currency still works. Banks still have adequate capital. These are not conditions that precede immediate collapse. They're conditions that precede disruption, followed by adaptation. So what should you actually do with this information? First, understand the difference between trend and cycle. The structural issues, the debt, the devaluation of the currency through inflation, the reliance on credit to fund consumption, these are long-term problems requiring policy reform. They won't be solved in the next crash. But the immediate cycle problems, the valuations, the leverage, the commercial real estate stress, these can normalize through normal market mechanisms. Corrections are how markets reset. They're not fun, but they're not permanent destruction. Second, recognize that crashes are fastest for the people who are most leveraged and least diversified. A 30% stock market correction doesn't destroy wealth for someone with 40% in stocks, 40% in bonds, and 20% in cash. It's actually an opportunity to rebalance. But for someone with 90% in Mag 7 stocks on margin, it's catastrophic. The difference isn't the crash. The difference is positioning. Third, understand that the worst predictions come from people who've made emotional investments in their narrative. If someone has been predicting a crash for 18 months and it hasn't happened, they have incentive to keep predicting it because admitting they were wrong is harder than doubling down. Be skeptical of anyone who needs the crash to happen. Fourth, monitor actual data instead of relying on narratives. What matters is employment, earnings, credit conditions, and Fed policy. When those metrics deteriorate, then adjust. When they're stable, position for disruption but not catastrophe. And finally, accept that timing is almost impossible. The yield curve inverted in October 2022. Recession didn't happen until 2025 in most assessments, or arguably hasn't happened at all in some measures. That's a 2-3 year lag. This is why trying to time crashes is stupid. You can be right about direction, but wrong about timing, and being wrong on timing costs money. Much better to be positioned for disruption and not try to call the bottom. Here's the harsh reality that neither the crash evangelists nor the permanent bulls want to admit. The economy is going to slow. There will be recession or near recession in the next 12-24 months. Stock prices will correct 20-35% from current levels. Some people will lose money, some businesses will fail. That's not a question, that's the cycle. The question is whether this is a normal cycle or an abnormal collapse. And the question is whether you're positioned for disruption or devastation. The data, not the narrative, says normal cycle with elevated disruption is more likely than abnormal collapse. But you have to be positioned accordingly, because the worst outcome isn't the crash itself. The worst outcome is being unprepared for it. The people who got destroyed in 2008 weren't destroyed because they predicted the crash wrong. They were destroyed because they didn't believe it could happen. They were maximally leveraged into assets everyone said couldn't fail. Same thing happened in 2000. Same thing happened in 1987. And the same thing will happen next time. Not to people who saw it coming and positioned accordingly, but to people who refused to believe it could happen until it did. So here's your real choice. You can believe the system is so stressed that collapse is mathematically inevitable, build your entire portfolio on that thesis, and wait for vindication. And if you're right, you'll be one of the few who wins. But if you're wrong, you'll miss the recovery while you're sitting in cash. Or you can accept that stress creates opportunities, position for correction without betting on catastrophe, and profit from volatility without needing crash narrative to be right. That second approach seems boring. It doesn't have the narrative arc of crisis and collapse, but it's the approach that actually makes money when it matters. The crash will come eventually. Crashes always do. But they never come exactly when predicted, and they never destroy everyone equally. They destroy the people who aren't prepared, who refuse to believe it could happen, who are positioned wrong when it does. If you're prepared, if you understand the risks, if you're positioned defensively but not catastrophically, then the crash isn't something to fear. It's the moment when patient capital profits. And that moment is probably closer than most people think, but probably not as close as the crash evangelists claim. The middle ground between permanent bull and crash catastrophist isn't sexy, but it's where actual returns live.